Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today we are going to be looking at SolarEdge and Enphase. I got a note from one of the Cyclical Investors Club members thanking me for warning them off of one of these, maybe both of them, I don't remember. And they thought that I should make a video kind of explaining why I decided not to buy these a couple of years. I think one of them was a couple of years ago, a year or two ago, when they were pretty popular. Now, part of the reason is I'm cautious, but I think the fundamental principle to keep in mind on why I was able to avoid these is usually when investing, history is the best guide to the future. Now, that's not always true. It's true in my experience. As long as you control for certain things that you can actually see are happening with a business, if it's declining or something like that, if you can, about 80% of the time, you can use what businesses and stocks have done in the past to give you a pretty rough guide of how they'll behave in the future. So when I look at something that doesn't have a history, a publicly traded history, for the time period that I would need to gather enough data to predict what they might do in the future, I avoid them almost always. Every now and then I'll make an exception, and I'll kind of talk about that too in the next step. But the first step here is, if somebody asked me about this, I would look at it. I would look at the history, which is only back to 2015. I would look at what the earnings have done. And so let's say they asked me in 2021. That's pretty good. I mean, there's nothing wrong with like what had happened there. They had a little bit of a decline during COVID, no big deal. And then I would look at the industry that it's in. But it doesn't have very much time, right? And the main thing you want to think about is how much time. What I'm looking for is what they did during a recession, usually, because recessions are where all the flaws basically get exposed by companies. And if you think it's going to be a cyclical business, I like to have 2 recessions worth of data, because sometimes a business can just like recessions are a little bit different in their character. And sometimes a particular character of one recession, usually you don't have 2 similar recessions in a row. So 2003 and 2002 and 2001, I'm not sure when they declared the actual recession. It was right in there. That was a very different recession than 2008. And also very different than the 2020 one, which is different than every recession except for maybe 100 years earlier, right? So if it's deeply cyclical, basically the stakes are higher, and you want to have more data to help guide you in the future, because cyclical business can be very dangerous to invest in. I focus on cyclicals, and I will still have one every, 6 or 7 years that will still go bankrupt after I try to kind of pick a bottom. But that's out of maybe 100, and so, because you have to take risk in order to kind of get the reward, and there's always going to be stocks that are kind of on the edge of that risk spectrum, and things that happen that you might not expect to happen. But if you have the data, a lot of times you can know what to have, at least to expect roughly. So we don't have the data here. It looked really good. I'm not sure what the value. Let's just see. Yeah, now it was valued quite richly up in here. But maybe in here, like before the pandemic, that's not crazy. It had been growing at, 40% or something a year and paying 35. Not so bad. This was much higher, but it was correctly predicting this growth that they were going to have. So none of this is too crazy until you consider that you can't extrapolate this. They still have it This is funny. These are analysts. So this is analyst prediction of the future. So when I check back in this in like 6 months, these are all going to be like disappeared because they're all going to be wrong. But this is what they do with cyclicals. They extrapolate things way out, like they're going to be awesome, and then they go down completely the opposite direction. The market freaks out, and then you get sell-offs like this one, which is 65%, and I didn't even pick the peak. So this is kind of what happens. But in order to figure out whether it's going to do that ahead of time, you need to look back into the past. There is no back into the past, so I would have avoided this. Let's look at, I would also look at the industry that they're into. I didn't talk about that. So this is if you see anything with a semiconductor, it's cyclical. But these are like solar companies, so it's a little bit different. It's not the same as semiconductors, but if you think about it, solar, residential solar, and to some extent even like any kind of office or industrial solar stuff, it is kind of a luxury, I would say, item or a discretionary item at this point for most people. So when times are good, that's when people spend on those type of things. Additionally, they're pretty expensive. So that means a lot of people are probably going to finance it. That means they need cheap debt a lot of times. In terms of the more people you can get to do it, the cheaper the financing is, the more it pencils out over 10 years or whatever. So that's cyclical. Housing, again, credit sensitive. A lot of these are tied to housing, right? That's cyclical. So all of the little components, any way you really want to look at it, is cyclical. Now, just because something is cyclical doesn't mean it can't be in a secular growth mode, which is pretty much what this has been. Let's look at Enphase and see if I can remember the ENPH. Okay. So they have a longer history, and you can see that they were not profitable basically all this time until 2018, and then they had kind of take off, and this looks good, and that was pre-pandemic, so you can kind of assume that it's not pandemic related. And then this growth is good. Now they really took off like in 2021 and 2022. So here's the other aspect of this. That's probably stimulus money, right? So again, we have low interest rates. We have a stimulus boom. We have, everything basically is going to go in favor of an upcycle and a super upcycle. So again, these guys were very, very expensive. Now they're down 65% or more. And the thing is, and they have more history, but they don't have a recession. And the history that they do have, wasn't like they were profitable this whole time, which is okay. A new business is going to take time to become profitable, and these guys might do well over the long term, but it's not going to go in a straight line like analysts are expecting, and definitely not going to go parabolic like they were pricing without ever having a drawback and I'm talking about earnings, not just the stock price. We can see earnings are down to 7% growth from 92%, right? And it's hard to predict how far the stock price can fall during a down cycle when you don't have any down cycles to look back on. The other thing I was going to say is you look at anything that basically has a semiconductor in the name, just assume it's going to be cyclical. Okay, that's just the best rule of thumb. There are a couple like semiconductor equipment companies, like a Texas Instrument, maybe a Lam Research, that are moderately cyclical instead of deeply cyclical. But most semiconductor businesses, even if they're in a growth phase, are just like these solar companies. They're gonna have downturns, and the stock is gonna crater, which is exactly what's happened. So, other than just rejecting these out of hand, which is hard for people to do because they hear the stories about how everything's gonna be awesome and there's all kinds of stories and the future's great and blah blah blah. you want to try to find some kind of a proxy to look at if you can. So in this case, I want to look at, we do have First Solar. They don't do exactly the same thing, but they're the only three solar industry stocks in the S&P 500. And in this case, we have a history, and we can kind of see these guys kind of had the same thing, a phase up here. Recession happened. People pulled back. Once that happened, they kind of leveled off, and then long earnings, this long down cycle, right? A little bit better, long down cycle. Until recently, when this kind of very long cycle bottomed, and then they kind of started coming up too. Now, they have already gotten earning. This could have been an accounting thing if you see it just drop off when everything else isn't dropping off. But it also could have been some kind of a bust. I haven't looked at their thing. Analysts are still saying it's going great, so that makes me think maybe they bought another company or something and marked off their earnings. But anyway, we can see that this is not a cyclical growth company. This is kind of a mix. Like, there's not a great pattern, but you can definitely see with this stock price. And there is a solar ETF, TAN, great name, great ticker. And I didn't look to see exactly what was in this, but this can kind of give you an overview of like what the industry cyclicality has been in terms of the price in the past across more than just one business, you know. So if you look at it, and I put First Solar in here too, we have this big super upcycle, again, with along with housing, right, tied to it. Housing crashes, it all crashes. We can see now since then, if we reset it down here, we got through this giant super cycle. Then we can see that we still have a lot of cyclicality, right? And now we're coming down. This is like a big bump. This is an extremely big bump. So, and this is just stock price. But if we go down, we can look at the drawdowns too. So this is what I look at when I'm looking for cyclical businesses, to see what sort of damage or opportunity, if you're trying to buy it near the bottom, that might be available. Now, if I would have brought this beyond 2012 back to like the peak, First Solar still, actually, let's just look at that real quick. They still have not recovered, I don't think, from their peak. So they're down 50% from their peak before the Great Recession, the stock price is. So that's how kind of crazy carried away these things can get. That's pretty similar to what we're seeing in terms of valuation. It's not so far off from where Enphase and again, we're probably more in a secular growth phase now than we were back then, but you can definitely see the long-term damage that can be done if you're buying it at one of these peaks. But if we take away the peak, we can see even since 2012 on both the solar ETF and First Solar, 65% plus drawdown, 65% plus drawdown. We have another spike here that comes down, and then this full one in the current cycle. These are just drawdowns from the peak. So whenever they make a new peak, it'll blank out at zero. And now we're down, at least on the ETF, 65%. And that's kind of where we are now. Now you could ask the question, when should we buy? Now might be a time to think about buying if I didn't think we were going to have like a recession. If interest rates hadn't gone from zero to like, I don't know, they're still going up. So then this would be a time where it'd be like, okay, well, maybe now's the time. But for me, this spike up is pretty similar to the one we had back here. And I think what I would do if I was looking to buy one of these and use this as a, like First Solar as a guide or TAN as a guide, would be, rather than trying to catch something like this on the way down, you really want to make sure that it's put in like some kind of technical bottom. These really look like super cycles to me. And we don't have enough data other than just those couple proxies. But if you think, okay, going into this, 140 was the peak, and then the drawdown was 70. You got to at least think it goes down to 70, because this wasn't even a real down cycle, and it wasn't coming off like a boom. So, and the way I would do it is I would wait for this to get below, and I don't know what kind of debt they have. That can play a role too. It doesn't look bad. Okay, so I think if it got below like $70 a share, then you can start looking for some kind of sign there's a technical bottom, either rising above like the 200-day moving average, putting in like a double bottom. Look for something like that, and then if you want to nibble at it, then that's the approach that I would use for it. If it's an industry that you think has the secular growth under the cyclicality, right? So you can have both. You can have, ultimately, a secular growth company will have higher highs and higher lows over time, maybe minus a giant down cycle if we get it. So we'll just say higher highs. And so if you can buy down during those lows and eventually growth comes back, then you're going to be doing fine as long as you have enough patience and nerves, because these can move a lot. Just remember, a stock falls 80% and you buy it and then it ends up falling 90%. Well, you lose 50% between 80% and 90% if you bought 80%. So be careful. And I think that's a good, just a general good approach. I probably won't be taking a stab at these. It's just, I think there'll be enough other deep cyclical stocks in the market that I have more confidence in, that on getting closer to the bottom and having a quicker recovery. That's what's good about having a history. You can look back and say, oh, this is something that recovers pretty in a decent time, you know, the last 3 recessions, right? Rather than something we don't really know for sure what's going to happen. So that's why I avoided these and avoided the pain here. And, you know, you just think about some of those methods when you're, now you're probably going to be thinking about buying a dip before, but whenever you're looking at something where the story is great, check the history, see if there's a history, check a similar business if that particular business doesn't have one. And look at this earnings history and see what it's done. Look at the price history in terms of drawdowns and see what's happened. And then that can give you an idea of whether it's kind of going to be more cyclical than you think. So we cover all this stuff in the Cyclical Investors Club. Like I said, one of the members had asked me about this, I think more than one, a year or two ago. And I was like, just not enough history. I didn't write a long explanation. And then I saw it wasn't related to semiconductors. And just those two things together, it was like, nah, it's too risky. But you can get into it more and ultimately figure out that it's actually going to probably be cyclical. Just don't believe the stories. Because go back and read all the great stories everybody wrote about this. And Enphase. And then you'll see that it's bullshit, you know? Either people don't know. I would say most people just don't know because they don't trust history. They don't look at the history. And then then there's like the real stock promoters that are just kind of trying to scam people that sold up here. They're the ones that sold up here that got everybody to buy. I don't think that's the majority of people. A lot of people are just excited to get something that's growing. But then they don't realize that it's not straight up growth. It's going to go up and down. Okay. I'll have links to the Cyclical Investor Club Premium. If you join Patreon for a couple bucks a month, you get a giant discount on that. And I'm going to be putting out a lot more videos because the market's getting kind of exciting right now. So I have a lot to talk about and a lot of requests, and I will get to all of them over the next few weeks. If you have a request, drop it in the comments, and if it's in the S&P 500, I will make a video out of it and post it here on the YouTube channel for free. Later.